Enterprise investment schemes are tax-efficient schemes created by the UK government during 1994 and which have since raised over 14 million in investment. They were designed to encourage individuals to invest in smaller, high-risk companies in return for a range of attractive tax reliefs that they cannot obtain via directly investing into the companies. There are a few qualifying rules to meet the ERS requirements. Firstly, investors cannot control more than a 30% stake in any company invested through AAS and can only invest up to 2 million per year provided anything over 1 million is invested in knowledge-intensive companies. In addition, eligible companies must have fewer than 250 full-time employees, gross assets not exceeding 15 million, and knowledge-intensive companies will be able to receive up to 10 million in EIS funding in a single year. They also must have held the shares for at least 3 years from the date of issue of the shares or 3 years after the commencement of trade. There are a number of benefits, which are as follows. Income tax relief of 30% is available to individuals for their entire invested amount in EIS. This tax liability reduction is up to £300,000 per tax year. Therefore, if you make an investment of £10,000, you can save up to £3,000 in income tax. Regarding capital gains tax, there is none payable or due on disposal of shares provided they are held for 3 years. By investing in EIS qualifying shares, investors can defer capital gains tax on gains realized on different assets. To be able to receive this relief, investors must subscribe for EIS shares during the period of 1 year before or 3 years after selling or disposing of the asset. Deferral relief is unlimited and can also be claimed by investors whose interest in the company exceeds 30%. So for inheritance tax or IHT, shares in EIS qualifying companies will generally qualify for business relief for IHT purposes. Relief can be at rates up to 100% after 2 years of holding the investments. Therefore, any liability for IHT is reduced or eliminated in respect of such shares. With venture capital trusts or VCTs, they began in 1995 to encourage investment into early stage companies based in the UK. Due to the risks associated with early stage investments, HMRC offered generous tax breaks for investors taking such risks. VCTs have therefore great similarities to EIS products, but the key difference is EIS allows direct investment into qualifying companies, where VCT is an investment into a trading company that goes on to provide the startup funding. VCT qualifications, they must also satisfy a number of key rules. First of all, the VCT must be unlisted at the time of investment with no plans to IPO unless it is onto AIM. The company must have less than 250 employees. The company must have been established less than 7 years. Funding raised by the company cannot be more than 15 million from VCT funds. Regarding tax relief, as mentioned, in order to encourage investors to take VCT risk, HMRC offers tax relief, including income tax, which is very similar to EIS, which is 30% on the amount invested, but shares must have been held for 5 years as opposed to 3 years with EIS. It is also important to note the maximum amount eligible for tax relief is 200,000. For example, if you invest £10,000 into a VCT, £3,000 will be taken off your tax return when you complete this. Dividends received via VCTs are also tax-free. So just a few EIS examples. A long-term client of ours who is a high net worth client and running his own limited company was looking at reducing the amount of tax he pays while also experiencing an investment. Before recommending this type of product, we had to ensure he understands the risks, especially the illiquidity nature, and we had to account for how experienced he was with these types of unregulated financial products. These products, although offering tax incentives, are not covered by the FSCS or the Financial Services Compensation Scheme, nor can the client complain to the Ombudsman. After taking the above into account, we recommended a £10,000 investment into one of our EIS schemes. As this was his first experience investing with an EIS, we only recommended a relatively small amount to start off with and to ensure he still maintains a suitable emergency fund and enough cash that is not locked away in an investment. During his next tax return, he was able to obtain tax relief at 30% of his investment, which is £3,000 of the £10,000. On an example of a venture capital trust, a high net worth client of ours, age 61, was in the process of winding down for retirement and was targeting an income of £5,000 per month. After performing our necessary due diligence and ensuring he understands the risks, that is those mentioned above, we recommended a VCT as one of the investments to achieve this. He had already fully utilised his ISA allowance, was already invested in structured products and peer-to-peer lending, so we recommended a VCT as the next investment. He was also looking at a tax relief investment, which the VCT would provide, along with capital gains free growth and tax-free dividends, the latter of which could be used to provide an income. The VCT also allowed for another avenue of diversification in his portfolio. If you have any questions regarding this video, please feel free to get in contact with us or book a seat at one of our tax seminars. Thank you.